Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. Gold continues to soar, but what about stocks and how is the US dollar doing? InsideTrackTrading.com President Eric Hadik takes a look at the cycles affecting various markets and how they might affect gold's bull run. Reporting from San Diego, RealEstateTiming.com newsletter publisher Robert Campbell gives us a snapshot of the U.S. real estate picture. Are people fleeing big cities? Plus, at the end of the show, we'll have company showcases from American Manganese CEO Larry Reaugh and Aben Resources President Jim Pettit. We'll talk to Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Reaugh, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome to This Week in Money, Bob.
Yeah, Jim, good to be with you.
Taking a look at the major markets over the past week, you said it was kind of a weird ending on Friday?
Yeah, they put in, the market was kind of soggy, put in a strong recovery with like the Standard & Poor's recovering to the plus side. But if you take a look at the big broad index, the New York Stock Exchange Composite Index, it was still down almost 0.5% at the end of the day. See what the bonds were doing. Bonds were unchanged on the day. Commodities came back a little bit, but it was just an interest. Actually, it was very strong into the close, recovering from a pretty soft day. Maybe it had something to do with end of the year. Maybe traders found that there were some vulnerable positions and they could squeeze the shorts. But the interesting thing about it, Jim, is that on the day, the dollar index stayed relatively firm. That's the U.S. dollar. So that was the distinction where there was a number of index made a comeback during the day and some to the plus side, but the broad market didn't make it to the plus side. We should take a look and see how the banks did. It's always an important sector. Yeah, they were down and recovered, but they were still down 0.4% at the close. And another one we look at is the XBD. That's the broker-dealers. And they were pretty soggy down until 1 o'clock Eastern time, and then started to turn up and then really jumped in the last bit, but they were still down 0.6%. So kind of soggy on the financial side. And I didn't have time to take a look and see if anybody had come up with any explanation for the strong close, but for the last few years, there have been certain parties, and you can't name them, but there's been quite an interest in seeing a strong close. For the bulls, it doesn't cost them much money to jam it up if you just sort of give them a hit just before the close. But I know ages ago on the old Vancouver Stock Exchange, on individually listed stocks, they really didn't like you doing phony upticks at the close. But I guess on the big board in New York, it doesn't matter that much. But it still looked, there still have been, over the last few years, the practice of doing phony upticks at the close. So we'll see how that goes.
Gold and silver still the big story?
Yeah. They're still looking good, especially after the hit into March, which was a horrendous crisis in both of them. And actually, it gives us a chance to tell our gold story, Jim, because in the bull market for gold and silver usually outperforms gold. which it was doing right up until the blow-off in 2011. And we monitor it by keeping track of, this time, the silver-gold ratio. And then there's a momentum thing on that you can do. And on that move in, I guess it was April of 2011, where it was a fantastic bull market, the RSI on the silver-gold ratio got up to 90. And we looked back and we knew that the only other time it had ever been that high, it was at the peak of the big blow-off in precious metals in January 1980. So it was very exceptional in 2011. And that, at 90 on the RSI was our bear signal. We said it was the action was dangerous and all that sort of stuff. And then at that point, you couldn't imagine that it would go eventually to opposite, and then many years later, and then in a unique crisis in February, March, that RSI got down to 11, which is effectively opposite of the 90. So where 90 in 2011 was our sell, the 11 in March was our buy, and we figured it was a cyclical buy, that this was the start of a new bull market for the sector. And the sector has been doing very well. Another way we look at it is if you take the real price of gold, that's the gold divided by the consumer price index, the rate of inflation, and in financial bubbles it tends down, and it did, but it sort of bottomed in 2018, and then it's been turning up since, and it has built a strong uptrend. And the importance of the gold's real price is that it reflects profitability for gold miners. If their costs are low, like price of oil, very low, and that it represents energy costs for the miners. So it's a plus, and so we've had that, the real price going up. The other way to look at it, Jim, is to take a gold stock index like GDXJ, and compare it to the S&P. And then it was underperforming since 2011, and particularly underperforming in the last couple of years of the big financial bubble. And then it turned up, so that gold stocks have been very nicely outperforming the S&P, which is also an indicator of a post-bubble contraction. So it's made the sector very attractive to an increasing number of investors, but it's going to go on for some years. But at the moment, gold and silver are looking good, but getting a little ahead of themselves. So at some point there'll be a correction, but our advice has been on the gold stocks to buy the dips. So it's a good sector to be in for the longer term.
How's crude doing?
Crude has recovered. You remember in February, in the crash down into March for crude, you had a huge problem with an outgoing contract, so that it really did trade down to minus 40, I guess. And that's an absurdity. But if you look at the chart I look at, I think the low was 6.5, and we're now up at into the young 40s. So it's had a very nice rally, along with the rally in base metals, a rally in lumber, and you've also had constructive work going on in credit spreads that have been positive for the stock market, and you've also had changes in the yield curve that have been positive. But the last two are credit markets, and they generally gave big warnings last year that there would be a change in the credit market. So, and when they are on trend, they last for quite a while, and the trend generally in interest or the credit markets is adverse now. So, but on the crash into March, our indicators became very oversold, And we counted out that typically a period of heavy liquidation in the stock market can last about 2 months, and that counted out to the end of March. And so I guess it was March 19th when we came out with that probably the worst is over and it's bottoming, and we'd look for a rally. We looked for the rally out to about mid-year, and it's at March stock market is generally kind of overbought and overvalued, and I think becoming vulnerable. So that it stayed sort of positive into here now is okay. You've had strong leadership from high-tech stocks in the NASDAQ, but also in the last little while, you've had some weakness in the banks and broker-dealers, which is a bit cautionary. So the market for gold and silver is strong now, but getting overdone.
Bob, thank you so much for being on the show.
Yeah, Jim, good to be with you, and we'll be here for you anytime you want.
My guest has been market historian Bob Hoye, the chief investment strategist for chartsandmarkets.com. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABN.AF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forrest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from the Chicago area. Welcome back to the show, Eric.
Oh, well, thanks for having me back, Jim.
Eric, first of all, can you just tell us a little bit about InsideTrackTrading.com?
Well, our entire service focuses on technical and cyclical analysis of the markets, first and foremost financial markets, but also a broader approach looking at a lot of different commodities and similar markets, and really trying to take some of the broader cycles and analysis and honing it with very specific indicators to make better risk control and money management parameters, and just taking that to a practical level on approaching and trading the markets. And so we provide different advisory services, different educational information, and also a lot of archived articles that deal with that type of analysis throughout the markets and throughout the world that impacts the markets.
Does volatility pick up as the upward move in a market is nearing the end?
Oh, you certainly get an increase in volatility, in acceleration of the swings, which really would be defining volatility. But you'll have one part during a trend where it is very defined, very one-directional, and in fact, anyone that's familiar with Elliott-Wave would kind of be defining that as the third of the third wave, where you've just got an accelerated move. In this case, I'll refer to an uptrend. So you have an accelerated move to the upside. There, you wouldn't really call it volatility. It's pretty solid. But as that parabola, that accelerated move, starts to unwind, that's when you see the real increase in the swings, the sharper vacillation in the market, up and down, as it's kind of completing that up phase and then starting to go into a topping phase. So towards the end, you definitely get an increase in the volatility. It's that part just before then when it's very one-directional.
Is the U.S. dollar cycle key to the gold and silver cycles?
I think that the dollar is definitely going to have and is having a more pronounced effect on this phase of the gold and silver cycle. I've been talking about this for several years now, but all of my work showed that gold should see a new bull market from late 2015, early 2016 into late 2020, early 2021. And ideally that uptrend is going to extend into about May of next year, May of 2021. But when we had the sharp drop in gold and silver in March of this year, it set the stage for kind of a culminating phase of precious metals uptrend, and I'm talking about a 12 to 14 month culminating phase that's the crescendo of this 5 to 6 year uptrend in gold, and that was the same time that longer-term cycles in the dollar peaked in March of this year. The dollar for decades has had a very consistent 38 to 41-month cycle that I know we've talked about in the past, too. And that combined with some more intermediate cycles, a very consistent 23 to 24-week cycle, and then even some shorter phased cycles than that, were all pointing at mid-March 2020 for a multi-year top in the dollar. So the dollar was spiking up, really just retesting its late 2016, early 2017, late 2017, early 2018 highs, at the same time that gold was pulling back and getting ready to enter a more accelerated uptrend. So during this phase of the dollar gold cycle, I do think that it's going to be more of your classic weak dollar, strong gold correlation, which you really haven't seen as much in the years prior. That inverse correlation has been very inconsistent, but because we're entering into these more significant phases of the overall cycle, my work has been showing and continues to show that this period from March of 2020 into April, May of 2021 would see a new dollar decline and a corresponding gold surge. And really corroborating that whole thing, you had silver spike to new 10-year lows in the middle of March. And during this just uncanny web of weekly and monthly cycles. In fact, I'd done some reports in mid-March that were titled The Week for a Low in Stocks and Silver, and it was this period between March 16th and March 23rd when both silver and the entire stock market, and along with that the gold-silver index, the XAU index, were all showing that they were putting in at least a 6 to 12 month bottom. And what I started discussing then was you also had now silver going into the phase of its overall cycle, where I stated back then that from March of 2020 into April, May of 2021, I was convinced that silver's gains would now significantly outpace the gains in gold due to the different factors that would be influencing silver and the fact that ratio had gotten to an extreme. And so it was very interesting that even at that bottom in mid-March, you had gold spiking down to about $14.50, silver spiking down to $12, and the ratio was almost a precise 120 to 1, gold over silver. And now this week with gold getting up to 1950 to 2000, depending on the contract that you're monitoring, and silver spiking up near $26, all of a sudden the ratio is at 77 to 1. So you're already seeing that contraction of the ratio, which is silver's gains significantly outpacing gold's. And that all factors into the dollar cycle, and also what I expect to be and have been expecting to be a 6 to 12 month inflationary cycle during that time, due to a declining dollar, due to all the new government spending we've had to see in response to the pandemic, and a lot of other factors as well. But it definitely has a strong correlation to the dollar cycle.
Do seasonalities tend to change within a cycle?
Seasonalities can kind of shift right or left on a chart, but a lot of the seasonalities, especially if you're talking about agricultural type markets or even financial markets that have your earning seasons, your banking seasons, those seasonalities often just combine to reinforce cycles, or to create the cycles, that they may be the governing cycle within a particular market. So, to really answer that specifically, you'd have to kind of go market by market, which seasonality you're discussing, which cycle you're discussing. So I think the two more are a case of some interplay together, as opposed to contrasting or contradicting each other.
Some silver seasonality charts show silver topping in late September. Where is silver in its cycle, and do you see an interim high on the horizon and a final top off in the distance?
I do, actually. In answering that final part of your question, I do see a silver top at, actually I see a couple of intervening peaks in silver. One of them, I think, is taking hold now as silver has gotten up to a critical upside target near $26. And so from a price perspective, I think that is going to contain silver for a while. And at the same time, there is a consistent 18 to 19 week cycle in gold that is also portending an initial peak, probably something that'll hold for a few weeks before the end of July. But then there are a bit longer term or longer intermediate term cycles that recur in September. And so I do expect to see another run up into that time frame. But as I was saying earlier, the much broader, longer-term cycles have me focused on the second quarter of next year. So I think that at least some of these metals markets, gold, silver, the XAU index, even platinum, palladium, and even copper, that you could see could be a divergence in highs where they set peaks in September and then have a larger and broader corrective phase during the fourth quarter this year, and then move back up into second quarter of next year, with some of them surging to new highs above whatever peaks they've set in September of this year, and others potentially peaking below those September 2020 highs. That would be kind of a textbook scenario within an overall market or an overall sector of the market for a more significant peak. So again, to kind of answer that question specifically, I think that we're at a probably a 1 to 2 week or slightly larger top now, as silver's spiking up to $26. I think we'll see a bit more significant peak in September, and then an even more significant top stretching out ideally into May of 2021.
We'll have more with Eric Hadik when This Week in Money returns.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Eric Hadik. Eric, where's gold in its cycle, and do you see an interim high on the horizon and a final top off in the distance?
Yeah, gold is definitely moving very similar to silver, even though it is not accelerating as much. One of the factors that I was talking about or alluding to when I talked about the gold-silver ratio was in March of this year when I was talking about this major bottom coming in the stock market related to 40-year cycle, an 11-year cycle, a 2-year cycle, a host of monthly and weekly cycles. They were all pointing to that March 16th to March 23rd time frame. And from there, I was looking for the stock market to enter the next phase of an uptrend that it, too, could probably stretch into April, May of 2021 before setting a final peak. That doesn't mean it goes straight up from now into that time frame. In fact, there's kind of a very interesting analogy that could be providing a roadmap for the next 6 months in the stock market. But my point in discussing the stock market is that prior to this, or leading into this March time frame, you were starting to get more volatility in the stock market. Back in August, September of last year, you saw a moderate sell-off. You saw a couple sell-offs in the beginning of this year before the larger sell-off. And gold was benefiting from that uncertainty in the market. Even as the market was progressing higher, each time it would have those setbacks, gold was really benefiting from that. And as we transitioned into this phase, when I thought the stock market was ready for a new uptrend, one of the presumptions with that was that you wouldn't have as many of those kind of flight to quality moves in gold, and that silver would be benefiting more from its industrial, economic, even inflationary type application, whereas gold would slow its ascent. But all in all, my work continues to show that gold should wait until second quarter of next year before setting a final peak. So between now and then, I think we're going to see some decent volatility, but the cycles are very similar to what I described with silver.
What kind of a cycle are you seeing with oil right now?
Oil has been certainly in a recovery mode, and I've been as much focused on price as I am on cycles, and most of my work is showing that oil could see an initial peak in the first half of August, but that it could stretch its rally into the second half of September. A little bit more significant cycles coming into play at that time. I've discussed a couple upside price targets that I have that will really help hone that timing analysis, because one thing I stress, even though a lot of our discussions might around cycles and timing indicators, I always want price action to be the ultimate filter, and more specific price indicators to be what I rely on for entry and exit of the market, because the cycles and a lot of your more subjective types of analysis are just a little too broad from a money management and a risk control perspective. So price is definitely my number one priority, and that's one of the filters that I'm watching very closely in oil. On a related note, one of the things I talked about throughout last year and into the beginning of this year was I thought that natural gas was coming into a major bottom in the first quarter of 2020, and that incorporated a lot of monthly and multi-year cycles. And the first stage of its recovery, I thought, would stretch from the first quarter of 2020 into the very end of 2020. And I'm still looking at that as the preferred scenario. So certainly that's one part of the energy sector that I think is in the early stages of a larger uptrend, and could continue into the end of this year.
Bitcoin, where is it?
Bitcoin, my broader outlook continues to be that we would see a 2020 recovery and leading into a likely peak towards the end of this year. And that continues to be my cycle outlook. Recently it has broken out to new multi-month highs, which has, certainly given it a boost and a little bit more attention, just in the last week or so. But it's kind of interesting to me that, that has occurred along with with recent dollar weakness, dollar dropping to new 6 to 12 month lows, the gold and silver surging to multi-year highs. And so you've had this dollar alternative move right now, but Bitcoin has really not, even though it had a nice surge the last couple of weeks from 9,000 up to above 11,000, its move hasn't been as sustained or as convincing as some of the other anti-dollar type vehicles. So I'm watching it closely up in this area to see if this is just a knee-jerk rally on the final phases of the dollar's recent sell-off. Really, the dollar has been in a downtrend since mid-March, but I think that it could set a 1 to 2 month bottom here at the very end of July or beginning of August at the very latest. And so I'm kind of watching to see how Bitcoin responds if the dollar does show some recovery. But all in all, I do think that Bitcoin's going to continue to work higher on balance into late 2020.
Where are we on the disease cycle, the disease cycle work that you've done?
Well, that's something that's such a broader cycle, but I know we've talked about it in the past. Really, the things that I was writing about back in 2014, 2015 dealt with a synergy of multi-year and multi-decade cycles that were converging in 2019, 2020. And it was everything from a very consistent decennial or 10-year cycle that had really seemed to emerge over the last century or two, where you would see a lot of these outbreaks, whether they were disease, virus, influenza, which obviously is a virus, but some of the most significant were really kind of hovering right around that 8 and 9 year of the decade, and sometimes flowing over into the 0 year of the next decade, so a consistent 10-year cycle. You can even look at most recent being the H1N1 of 2009, but you can go back through the 1900s. At the end of several decades, you had different influenza outbreaks, and then go all the way back to 1918 and 1920 with the Spanish flu, and back through the 1800s too. Several Chinese-related outbreaks that all came into play at that end of the decade. So it was almost like a consistent 10-year cycle, but overlapping that, there were several other cycles that I had discussed back then, a consistent 17-year cycle, and you'd have to kind of understand my focus on that particular cycle and why I believe it's a very significant cycle. But that also was coming into play in 2019-2020, 17 years from the SARS outbreak of 2003. And if you keep going back on 17-year increments, you'll see previous outbreaks on that. You had this 100-year cycle that has now more recently gained some attention, and a 40-year cycle in there. They were just all converging in 2019-2020. So we're in the midst of that. It's not something that you can really, from my perspective, you could take down to any smaller increments. I think when you're talking about broad cycles like that, it is far more of an art than a science. It's more general. You're not going to pinpoint months or weeks within those cycles. So we're in that phase, and it could certainly stretch out another year, but at this point it's kind of discussing what we've already been through. But I have these reports dating back to 2014, 2015 that I've had more readers request some of the archived copies of that, but this is something being discussed many years ago. Had no idea what type of disease or the extent of it, but from a cyclic basis, it was all focused on the 1 year either side of 2019.
Eric, you've also done work on conflict cycles. Where are we in that?
I know that we kind of review or revisit this topic many times, and my work is still the same, that 2021 is when I see a resurgence of war cycles, and usually leading into that, you see, many years of tensions rising, and that too is, again, it's the synergy of so many different cycles, but the most significant that I'm focused on is a 40-year cycle and an overriding or overarching 80-year cycle. That 80-year cycle within America's lifespan, it connects the culmination of the Revolutionary War, really culminating in 1781, to the outbreak of the Civil War in 1861, to America's entry in World War II in 1941, and coming forward to 2021. But that 80-year cycle, when you incorporate Europe and the whole global population, that 80-year cycle goes back hundreds of years and pretty precisely times many of the most significant conflicts over the last 500-600 years. And so I continue to focus on 2021, and you certainly see a lot of seeds planted that any one of them could fulfill that, but you often get something out of left field too. So as we approach that time frame, I'll certainly be monitoring current events and how things look at that time. But certainly things like the South China Sea continue to be a growing hotspot. Middle East, even though things have been relatively quiet of late, there certainly is still the potential there, and a lot of regions that you may not think of right at the forefront of discussing war cycles, but there's others that can't be ignored as well.
Eric, thank you so much for chatting with us.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from the Chicago area. Coming up, Robert Campbell, next on This Week in Money.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Robert Campbell. He's the publisher of the Real Estate Timing newsletter, realestatetiming.com. He's speaking to us from the gorgeous city of San Diego. Welcome back to the show, Robert.
Thanks for having me back.
Robert, how important is the Federal Reserve for the U.S. economy at this time?
I would say close to 100%. And I say that because nothing's 100%, of course. Let's just say it's probably at least 50% of the U.S. economy right now. And that's what makes it so crazy to try to understand, because never in history have we experienced anything like we're experiencing right now, where the Fed is physically printing up money and just handing it out to people to the degree that it has. It's like, and there's still no end in sight, and that's what makes it so fast. We've never seen that before in U.S. history.
The coronavirus panic, quarantine, lockdown continues in some states, not in others. Do you think the U.S. or portions of the country could be in for a recession or even a depression?
Well, we're already in a recession. I mean, we know that. In fact, Q2 GDP just came in at not when they annualize a quarterly figure, but looking at a year-over-year figure, it was down a little bit below 9%, which is the worst quarterly reading since at least 1947. So, I mean, that gives you some perspective on how bad this downturn is.
Can the Federal Reserve continue to bail out the U.S. economy indefinitely?
No, they can't do that indefinitely. And I mean that there will come a point. They can do that indefinitely, but the whole system will change. We'll start turning into Japan, where the stock market hasn't gone anywhere in 30 years. Real estate values have been hasn't gone up in 30 years. In fact, they've gone down almost all those years. And that's because the Federal Reserve takes over. So it has consequences, where the value of the currency just becomes worthless. I mean, look at what's going on in Venezuela right now. How they decided to save the system after everything turned to shit. They just started printing up money. And how's that turned out? There's things that can happen, and you just can't say, Jim, it's not going to happen here. That's crazy talk. It can happen anywhere at any time, and there's no way you can't say, that would never happen in the United States or Canada or whatever. It can happen because it's primarily triggered by a psychological event where people lose confidence in the government and the currency, and they start spending it as fast as they can because it's already losing value to speed, and it just increases the rate of depreciation, and that's when you have high inflation. And that's another risk we face right now. We face high inflation. At some point, inflation is going to come back. I mean, I lived through the 70s and 80s when we financed the Vietnam War with debt and printed money. We didn't, the taxpayer didn't pay for that with Treasury. Maybe it went on the Treasury or something like that. But we didn't have the cash to do that, so it was all financed. And then all of a sudden, for some reason, inflation took off in the 70s, and the dollar crashed. The economy sucked, and inflation got up in the early 80s up to 13%. That's when the Fed had to step on the brakes. That was Volcker, step on the brakes to save the dollar. And mortgage rates went to 18%. I mean, let's say inflation took off for some reason in the next 5 years, and the Fed saved the dollar, assuming they want to save it. I mean, they have to do something to save it, so they'd have to raise to get money flowing back into it. They have to raise interest rates to like 20% for Fed funds to save it. Well, what do you think that would do to the economy at this point? An economy leveraged like ours. So that's another risk.
The U.S. dollar's been sliding. What do you see ahead for the U.S. buck?
Well, you just got to go with the trend. The trend's down. It's clearly down. And so, I mean, and that's the point, that, the dollar's losing value, that all of a sudden, when the dollar's losing value is when they're losing confidence in the U.S. currency, of course, like the bond markets, the people to pay that stuff off. People don't want to hold dollars. They'd rather hold something else that they perceive as being safer. Hell, the euro's outperforming the dollar now. The euro sucks.
Gold's broken out to new highs. What are your thoughts on gold?
Well, I've anticipated this for the last 2 or 3 years. That I took a position based on gold, based on its historical pattern of counter cyclicality with the stock market. When the stock market goes up, gold goes down. I thought the stock market was going to go up, so I bought gold. That was one of the reasons I bought gold, and they both have gone up. So, but I think there's a good chance. There's a cycle guy I listen to. I think his name is Charles Nenner, Nenner. He's a real cycle guy, and he's been around a long time. He gets a lot of good calls. He misses calls, of course, but he makes a lot of good calls. He thinks gold's going to bottom in 2025, based on historical cycles. So that's kind of along my way of thinking, that, there's no fever like gold fever, is what my friend Richard Russell used to say. And wait till this thing gets rolling. I mean, that's when the money starts pouring in. Gold's only starting to get noticed right now, Jim. Starting. Yeah, wait till it goes, wait till it gets to be 3,000. That's when the money will start. But so I think it's going to a big number, and to me, it's the best investment in the world right now, for not only from a cyclical standpoint, but the standpoint, where the world's going. Because gold tends to be a fear investment, and there's a lot of fear in the world right now. So I think the future outlook for gold is going to be bright, and it's probably going to be the best performing asset during the next 5 years.
How long do you think this gold bull run will last?
I think it's going to last another 5 years. I mean, 3 to 5 years. According to Nenner, he says 2025. 3 to 5 years. I mean, I think it's going to make a big move. And one of the reasons it's making a big move, it's not because it's because people are losing trust in the governments, in governments. Martin Armstrong mentions that loss of confidence, and they just want to put their money in something that they trust, and what they trust right now is physical gold. So, that's not that's not something governments like to brag about. People rather own gold than rely on us.
Is there a correlation between government deficits and gold?
Absolutely. In fact, the listeners may have heard of John Hussman, Hussman. He in a couple of his past letters, he showed gold movement as tracked against how big the U.S. deficit was, and the correlation was high. And I was impressed. I'd never seen that before. So I hadn't seen that before. I said, because I love correlations. That's what gives you an edge in the market. So I'm saying, okay, what are deficits doing right now? They're out of control. They're out of friggin' control. I mean, in the U.S., I think it's like $3 trillion this year or something like that. I mean, and next year it could be the same or even more. And so that has to bode well for gold.
Silver's broken out of a long-term trading range, yet it's trading around half the price of its highs back in 2011 and 1980. Is silver likely to play catch-up and move to new highs?
Yeah, I think it is going to move to new highs. I think long-term gold is a safer, less volatile investment than silver, because gold's a monetary metal. You know, that Fort Knox isn't going to be full of silver bars. I mean, they'd have to increase the size by about 50. So, I mean, gold serves that purpose. But I may have told listeners all along what I think there's a good chance they're going to do. I think they're going to revalue gold like they did in the 1930s. 1930s, not only to save the economy and get some inflation back into it, what was deflationary at that point in time, but I think they're going to revalue gold to a big number and then back the U.S. currency with gold. And the reason they're going to do this is they have to save the debt. They got to save the banks. If all those loans start going bad, and especially they're in the dollar, they're crap loans anyway, and they're financed with dollars. I mean, there's no collateral behind them. All of a sudden, you might have to put up some collateral behind them, like, a 20 or 30, percent position of convertibility into gold, and all of a sudden, boom, nobody has a problem with those bonds anymore. So all the rich guys stay rich, because it's rich people that own the debt and the banks and that kind of thing, and you save the system. I think there's a good probability that's what's going to happen.
We'll have more with Robert Campbell when This Week in Money returns.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with Robert Campbell. Bob, is continued civil unrest likely in the U.S. even following the November 3rd elections?
It's probably going to get worse, Jim. Whoever wins, the other side it will not accept the results at all, just like it is now. So I see this continuing, on and on and on until we really have a breakdown in the system, probably a reset of the financial system, some, financially and emotionally hard times, and even there's a good chance that Martin Armstrong, I believe it's he who thinks that the U.S. is, at least based on his long-term cycles, the U.S. is scheduled to break up into individual states in 10 or 15 years, similar to what Russia did in 1990. So, I mean, people go, oh, that's crazy. Nothing's crazy anymore. I mean, just study history. I mean, that can happen because of the civil unrest that we're having in this country. The hate, the level of hate just keeps rising. I mean, and that's why I'm saying, they said, okay, well, you stay over here and we'll stay over here, okay? So we don't have to, we can all have our own state. And I'm sure like California, Oregon, and Washington would all combine together, where everybody lives in a socialist paradise. They get a check from, I don't know where, for $5,000 a month, and they don't have to work.
And we have great beaches here on the coast. Why not get a government check and just live on the beach? What's the state of the U.S. housing market overall?
It's holding up extremely well because, my market timing model, which is correct 80 and 90% of the time, for California example, it gave a sell signal back in January of 2019. Well, California is still struggling, and I never got any signals for the rest of the United States, just for California. And it hasn't crashed, but it certainly hasn't gone up. It's almost gone flat. But the rest of the United States is doing way outperforming California. In fact, it's doing historic, sales are up, and it's just surprises that I just can't understand it. But you don't try to understand things. You just observe and see what's happening, and then try to figure out, what explains what's happening. But it's holding up really well, and my best guess is that the full impact of this recession hasn't hit yet, and also the numbers that we're seeing, the latest numbers are June numbers. I mean, it's going to be a lot more interesting as we see these numbers run through the next 3 months, 3 to 6 months through the end of the year. Because historically, real estate always does terrible during a recession, especially California real estate. I mean, and we're in a bad recession. So that kind of thing, those factors aren't coming together on a historical basis where, we're in a real bad recession and real estate's still going up. That normally is not the case.
Is the continuing lockdown likely to cause a buildup of yet-to-be-listed housing inventory in California?
Oh, I think that, or across the United States. What are they? They're almost like, 4.8 or something million people in forbearance where they don't have to make their payments. Wait till that eventually ends, right? And I think, that's something like 8% or 8% of all people that have mortgages. I mean, they're not making those mortgage payments because they're in trouble. They just haven't lost their house yet because nobody forecloses or they can forbear on it and all that kind of stuff. But when the day of reckoning eventually comes, I mean, way over 50% of those homes are going to go on the market. And another thing, a lot of those homes may go on the market anyway, whether it's from a maybe that might not be a distress sale from the standpoint they're underwater on it, but a lot of those people may put their homes on the market anyway because they need cash. They need to sell their house to generate cash to live on because the house is an expense. I mean, maybe they need to downsize. So, but the way I see things, those 4.8 million mortgages in forbearance are, that's a sign of, highly likely that's a sign of future trouble.
Is there a real concern of a possible real estate collapse in the U.S.?
Yeah, there is that. And that would be under the situation that if we got into a Venezuelan type of inflation, hyperinflation, that maybe doesn't even have to be that bad. Where let's say mortgage rates went up to 30, 40% or something like that because nobody's going to lend money when inflation's going off at 100% or 200% or whatever. Okay, all of a sudden, at that point in time, financing is no longer available, Jim, and real estate turns into a cash market. So, in other words, if you were holding gold, for example, instead of real estate, gold's soaring because it performs really well during inflations and hyperinflations. Real estate's going the other way because without financing, I mean, what can people afford to pay for a house? Most people don't have much money, pay cash. So the price may drop 90% under that situation for like a year or so. And then everything will kind of get back under control. And, so if you sold your gold and bought your real estate there, that would probably turn into be a real good, good longer term move too based on the coming cycles.
Are banks becoming stingier with their loans, especially mortgages?
Yeah, I think I read that they are. That I'm not a mortgage broker. You'd have to talk to somebody, an honest mortgage broker, about that. And I understand there's a few of those around. And and I'm just kidding, guys. But I know things like HELOCs. They won't let you do a HELOC. I don't think they'll let you do a cash out refinance. No cash outs. Or they put limits on it and things like that. So things have definitely tightened as opposed to loosened, net.
At some point, will it be a good time to buy California real estate?
Yeah, I think it's going to be a good time like 2025. Just about and that's my strategy because I like gold a lot. I think gold if gold runs to 2025 and does some of the things I'm doing it, I'll sell half my position in gold at a super high price and buy a good piece of real estate here on the coast in San Diego at a super low price, and wait for the cycles to reverse. But I think that's a strategy I could easily see happening based on cycle theory and patterns of the past and that kind of thing.
We're hearing people are bailing out from big cities and now looking to buy in small towns. I guess especially because now you can work from home and don't have to be next to the office. What could this mean for real estate values?
Well, I think that this could be a real game changer here. For one thing, let's use San Francisco as an example because it's so notorious for high rent. Like right now, the last data I looked at maybe a month or so ago, a one-bedroom in the city of San Francisco went for like $2,700, and a two-bedroom went for $4,200. And you work for Google or Twitter or some company up there that you're making a lot of money, and so you can afford to pay those rents even though they're super high. Well, all of a sudden now they had to shut everything down, and now you move somewhere else where, let's say you're not making that much money. Now all your money is going out the door in rent primarily, but you got a job. You could move to Reno and get that same one-bedroom apartment for $800, instead of $700, instead of $2,700 or something like that, and bank the $2,000, and you can work from home. And businesses are definitely leaning in that direction. So when Twitter and all these companies start doing that and start leaving their downtown San Francisco digs, these high rent office buildings, you could see vacancy go to 40%. And what's that going to do to commercial real estate? It's going to kill it, because this work at home thing is a big deal. And all of a sudden now you don't have to drive your car as much. And if the guy's a good worker, that you're going to keep him. If all of a sudden he doesn't do well working on his own, you should fire him, because you can't afford to have him in an office place anymore. But you're just going to have to find good people. But I could see that as being a big reason. So what would that do to the rental market in San Francisco? It'd get crushed. One bedrooms aren't going to go for $2,700. Now they're going to go for $1,500 or $1,600. Gee, what do you think it would do to the value of that multifamily dwelling and the big mortgage that's against it? So that could have catastrophic effects. And people are bailing out of California anyway, Jim. They're leaving California now. California, Illinois, and New York are the two biggest states that they're leaving. And it's not just young kids that are leaving. It's people that make money that are leaving, with businesses that are leaving. And so that's a trend that's certainly in play right now, that they're leaving the high tax states. So this is going to be an interesting decade ahead of us.
Is the U.S. or parts of the U.S. likely to see structural unemployment for the foreseeable future?
Yeah, I think so. Unless the Fed just bails everybody out, because right now 5 out of 6 of the 32 million people that are receiving unemployment benefits are making more money unemployed than they could working. So what's the incentive? There's no incentive. They've just totally bailed these guys out. And so I think that, that you could see 10 to 15% unemployment for the next 5 years. And that's a huge downturn in employment. That'd be the worst in U.S. history, recorded history. See, we have a lot of trouble with the 1930s, because most of the data kept then was based on was yearly data. So what happened in between, January of one year and January of another year on a month-by-month basis it's almost impossible to tell. And our data today is much better, but based on bigger trends, it'd be worse than the 30s. We have a choice this country is going to face. The U.S., maybe other countries in the world too. If you believe that this COVID, isn't as bad as it's being made it out to be, just let it run its course like you do any seasonal flu. 1% of all people die. Sorry to see that, but that's the price you have to pay. Instead of wearing a mask and social distancing for the next 3 years, where 20% of the U.S. economy will be permanently deleted. You're not going to have both.
Do you think it's going to be difficult for major sports and the concert industry to get their audiences back, even if there's a vaccine?
Oh, absolutely. People are afraid. This is going to take a while to wear off. The people that are scared, knowing what I know now about it, once we've gone through the herd immunity thing, and it's no big deal, I'm not afraid to go out to nightclubs or anything anymore. I'll do that. But there's some real people that are scared shitless out there. A lot of them won't. One thing, but if I have to wear a mask, am I gonna fly from San Diego to Hawaii to see the islands if I have to wear a mask? No, I'm not gonna do that. And I love Hawaii.
For years, we've been hearing China will be the next superpower. Does that seem likely now?
Yeah. I'd probably say yes. And it's a combination of them getting bigger and stronger and us getting weaker. You know, the strength of the U.S. economy, year-over-year growth, decade-over-decade growth, has been declining for like 40 or 50 years, Jim. You know? I mean, tell me one empire in the world that has lasted forever. You know, it wasn't that long ago that Great Britain was the power of the world. Remember when the British pound was a world reserve currency?
Well,
that trend didn't last forever, did it?
No. Once World War II was over and they were broke, it went to the U.S. and their petrodollars.
Great explanation. I didn't know that. I didn't know all those details, but you know, I trust that you do. And things change. That's why you know. You guys have had Martin Armstrong, and I'm a big follower of Martin Armstrong. He says the U.S. could divide up into 5 states. That's exactly what Russia did in 1990. They had all these problems, and they had to divide the USSR up into 5 or 6 different states. Look what happened to Yugoslavia when they had to break up. I mean, so you know, this isn't going to be the first time in history this stuff. If the U.S. did that it's ever happened. That's the way the world works.
Do you think the U.S. federal government would try to physically, using force, try to prevent a state or two from forming their own little independent country? Or would you just let them go and say good luck?
So what? They probably would. They'd probably use force. Because the federal government has way more power than a state government, right? For one thing, they've got the military. If it comes down to that. And that's a great question because, you know, sometimes that's when people aren't going with the program, that's what, you know, dictatorship programs tend to use. They use force.
So someday there could be B-52s over San Diego?
I doubt it'll get that. It won't get to that point, Jim. When you see B-52, what are they going to be? A carpet bombing Del Mar or something?
Yeah.
That's where all the conservatives live?
Yeah.
That's funny.
Do you think it's a coincidence we have a virus panic, government forced lockdowns, and a push towards Marxism around the planet?
I think this COVID has been exaggerated, the danger of it by about the factor of 10, and the reason they're doing that is to get Donald Trump out of office. They can't run the show that the left-wing lunatics want to run it with Trump around.
Bob,
but that's, I mean, what's changed? They started impeaching him, didn't they, before he was even ruled into office, sworn into office. So something's up.
Bob, do you have any conventional wisdom you can share with us, and then maybe some health tips?
Conventional wisdom. Let me tell you something that I've learned in the last 6 months that's make a big difference in my life. And one of the things that I've always told people, I said, you can't be bothered whether somebody likes you or not. You just can't let that bother you. I know that you know, my dad told me when I was a little kid, and he said, hey, some women are going to love you and some of them aren't. Pay attention to the ones that do. So that's what you do. Not everybody's going to love you. Don't focus on them. Just focus on the ones that do love you, you know, whether it's a woman or your friends or something like that. But secondly, I've kind of taken that a little step further. I think that removing people from your life that don't deserve to be there is one of the most supreme forms of self-respect that you can show the world. Because you know what, and I don't care who it is, because that all of a sudden, I mean, one of my things is about life is that just don't, you know, be the secret to happiness is be healthy and fit and avoid shitty people. So you got to get rid of those shitty people. It doesn't matter who they are, and focus on the good ones. And because don't let the shitty ones bring you down. And it doesn't matter who they are. You just got to make that decision. And so all of a sudden, you know, you've got all these good people around you, nobody's shitty, and all of a sudden, life gets a lot better. And stay physically fit, everybody, and healthy. I mean, that's the secret of happiness. You know, you can't do anything you do in life successfully, you'll do it more successfully if you're fit and healthy. Everything. You know, the women that go out with you will be prettier, you'll get better paying jobs, you'll be more successful, you'll be a better baseball player. everything. So there's all upside, no downside, and that's why I'm saying that, taking care of your body is the highest form of self-respect. And I've been doing this since I was 18 years old, so that's almost 55 years now. So I'm not just, this isn't something about a book I just happened to read last night. I've been doing this my whole life, and it's a lot of hard work, everybody. Only 3% of all, everybody wants to be healthy and fit. 3% of all people are willing to work hard to achieve that goal. Only 3%. So, but if I only save 3%, you save 3% of the world, that's fine with me. Like Dad said, you can't appeal to everyone. So that's my health tip.
Bob, how can people find out more about your newsletter?
You can go to my website, and it's realestatetiming.com. There's no hyphens or periods or underlines. Real estate, you know how that's spelled. Timing, timing.com. And you can learn a little bit more about me. If you want to learn how I track real estate markets with the timing model, I wrote a book, Timing the Real Estate Market, that tells you exactly how to do it. And I write my own timing letter for people that are too lazy to do all that work on their own, which is completely understandable. Because it is a lot of work. Nothing good in life comes easy. But is it a good return on your investment, the time spent? Absolutely. Maybe one of the best returns on investment. So realestatetiming.com. And you can read about me. You can subscribe to my timing letter. There's even like a 2-month subscription that's real inexpensive just to introduce you to me. If you haven't read me before, you can try me out like that, and then go for something better if you like. So, but that's it. These are real interesting times, guys. I mean, hey, listen, I'm an economist. What I'm doing right now is I'm just trying to observe the world around me, and then look at the facts and try to explain it. I don't have that reverse where some people develop a theory and then cherry pick the facts that support their theory. That's just the opposite way you should do it. You just have to say, what's going on right now? And why do you think that's happening? I mean, what's going on is more important. But you go, would I expect real estate to be this strong under these economic conditions? Never in a million years. But guess what? It's happening. So the whole thing it seems to be all different than it was in previous cycles. Primarily because the Fed just has the money, the money spigot's wide open, and they'll pass out as much of this money as they can. They're not going to let the housing market collapse, the stock market collapse, all this stuff collapse. I mean, it eventually will, because the currency will become worthless unless they revalue it by gold, which I think they're going to do. So that's the way I see the big picture, but I play the short. I can change my mind too. If the data changes, I change my mind. But I've been feeling this way for at least the last 2 years, so it's pretty solid right now.
Bob, thank you again.
You're welcome, Jim. Talk to you later, man. Bye.
My guest has been Robert Campbell, author of Timing the Real Estate Market and the Campbell Real Estate Timing Letter, online at realestatetiming.com. He was speaking to us from San Diego. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Eric Hadik, and Robert Campbell, and thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. And now, stand by for company showcase updates from American Manganese CEO Larry Reaugh and Aben Resources President Jim Pettit. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Jim, it's always great, and we're looking forward to a long weekend here.
You have some great news about your pilot plant.
Yes, Jim, I've been repeating myself for the last 6 weeks or so, waiting for a part that was being fabricated in China. And we finally, Cametco has finally received that, and they will be putting the parts onto the existing equipment, and replacing parts on the existing equipment. Then they'll do some water testing to make sure we don't have any leaks. And hopefully, I think we'll be sometime mid-next week, we should be back running the pilot plant. And just to speak about that, we had a fantastic first run on that pilot plant where we increased the throughput by 2.5 times. And you would think that we actually lost 2.5 times the throughput the way the markets reacted with the sales that have been going on. And but now we expect to even enhance that number. And what that means, of course, is that we can put through more through smaller plants that will have less OPEX, and certainly the CapEx will go down too. So that's a big benefit to the shareholders. And before we design a plant in full, we want to maximize or actually increase the throughput through the plants, and so maximizing optimization is high in our book, and we're going to be moving through that. And we also had a release last week on spinning out our gold assets, and just to let people know, I think some of them really don't understand what that means. And what it means is, let's say you had 10,000 shares of American Manganese, Inc. At the time of the spin-out, if you're a registered shareholder, or if you hold those shares in the share form, you're entitled to the spin-out shares from Nuco. So we don't know the ratio because that's not determined by us. We'll make recommendations. And but it's determined by the courts and a judge. So we expect to keep progressing this thing through the chute. One thing you can be assured of, we have the experience from taking 20 companies public, and I have to say that in this particular case, the asset is the best I've ever had to put into a new company. And as a past producing, high-grade producer of copper, gold, and cobalt, and a significant number, not just a few carloads, although we had a few carloads that were shipped off that property that ran up to 6 ounces of gold and 7% copper, but the overall grade on the actual mining operation was 6% copper, and about 0.1 ounces of gold, or let's say 2.5 grams of gold. So it was a significant producer at the time, back in the 50s, and we're just chomping at the bit to get back onto that property. Now, what I started to say was, what you have to look at is, say you own 10,000 shares of American Manganese, and so that entitles you to shares in the Nuco. And if it was, say, and this is hypothetical, if you say that, okay, we do that on a 3 or 4% share split arrangement, basically I'll work with the 3 because it's an easy number to work with. If you had 10,000 shares, and for every 3 shares of AMY you had, you would get 1 share of Nuco. So that would entitle you to 3,300 shares at no cost to you in a new company that is dominated by gold and copper, which are going up through the roof. I think gold is on a long-term bull. Why I say that is that there's going to be a lot of inflation that's going to come out of this printing of money for the COVID virus. and maintaining workforces and people's salaries and, stay at home, production down. All these things will increase the price of gold. Why? Well, the more money you print, the more you devalue the money, and the value has always been in gold. It's a 5,000-year history of being the currency of the day. And so getting back to the split on the company, that if you had 100,000 shares and not 10,000 shares, that would be 33,300 new shares in on a hypothetical 3-for-1 split. The not split, but call it a dividend. The Spinout would give you 33,000 new shares in a very hot prospect that I have no doubt will meet all the criteria of the exchanges to become a listed company. So I just wanted to bring that to everybody's attention. It's simple to say, I look at the shares that are trading, and I think, this can't be shareholders that are selling the stock because they don't want the free shares. It's got to be coming from somewhere else. And I've talked enough about predators till I'm blue in the face. But, they should, in all rules and regulations, they should have to buy those shares back so that the original shareholder, if they borrowed it, qualifies for the new shares, Newco shares. So this thing has got a lot of things working for it, and I just want everybody to realize that this is something the company decided on to reward our shareholders, and taking it out of American Manganese and putting it into a Newco helps the focus go on the gold and the base metals that are in that project and rare earths. So it's a great thing for them. I mean, geez, I'm looking forward to a Newco shares. I hold close to 4 million shares, so that should result in a fair position in the new company. And we have a lot of shareholders with some have more than I do, some have less, but we have a lot of million holders of shares, a lot in the hundreds of thousands range, and that you can see the impact of the benefit. But even if you only had 10 or 5,000 shares, what's wrong with having shares in a gold prospect that cost you nothing? So I think we're all looking forward to a great long weekend and the startup of the plant, and so it's been a busy time here. We got other things on the go, as well as taking on this new job of spinning out the company. But that's what we're here for, and we'll work the hours that it takes to do all that. So, Jim, you have a good weekend.
Larry, for people new to American Manganese, what's the company all about, and where can they find your trading information and information about the company?
Well, the American Manganese is a critical metals company that has developed a process for treating low grades of manganese. And that was a cornerstone of our current technology push on recycling lithium-ion batteries, which is going to be a tremendous business going out into the future. And so you can find all that information at our website at AmericanManganeseInc.com. You can phone the company at 778-574-4444. Or you can email me at LREAUGH@AMYMN.com. And don't forget that we trade on the Toronto Venture Exchange under the symbol of AMY. We trade in the U.S. under the symbol AMYZF. And we trade on the Frankfurt Exchange under the symbol 2AM.
Larry, thank you so much for the update.
You're welcome, Jim.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on July 31st.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm Jim Goddard. I'm speaking with Jim Pettit, CEO and President of Aben Resources. Welcome back, Jim.
Thank you very much, Jim.
Busy summer for Aben Resources?
It's gearing up now, yep. I just got the crew up there last week. Got the camp set up, a few kinks and things that had to be ironed out, but they're out there working. They're in the field. They're testing, ground truthing existing targets that we want to drill. We're just trying to prove them up even more. And they're looking for new targets, too. Now we've got the wealth of knowledge from all the drilling. We've overlaid all the geophysics and all the mag anomalies. Some of these are controlling mineralization. Plus, there's more faults. We know a lot more about the faults in the area than we did before, and it's allowed us to think we're a little smarter than we have been the last few years. So we're going to move back into the North Boundary area, but across the valley floor, where we think that there's probably an area there that's ripe for drilling. We do know that on surface there's all kinds of high-grade samples that we've already picked out of there last year, and I mean, surface rock samples, lots of samples. The grade variation is like from 10 grams to 43.5 grams gold, 29 grams silver, up to 46 grams silver. And as far as copper goes, too, there's copper there. 1.3% copper up to 4.6% copper. So there's something very active in this one area, which is, just not even 500 meters south of North Boundary. It's across the valley floor, so it's across the Nelson Creek Fault. And what's got us excited is one hole we did drill last year from the North Boundary side of the fault, which is the east side. We drilled underneath through the Nelson Creek Fault, and the end of that hole ended in mineralization. 17 meters of it, 0.3% copper, 2.5 gram silver, and 1.2 gram gold. It's there. It's downhole. It's directly underneath where all the surface samples were taken, and that's an area of about 300 meters. So there's lots of ideas for us right there to accomplish, and then we've also got some new areas a little further south, but there are faults, coming in at different angles and crossing, and it's an area and then it also shows the geophysical anomalies just in the right spot, very, very like a mirror image of the North Boundary high-grade mineralized zone. So we've got some areas to test for sure. We'll probably start off with about 2,000 meters of drilling later in August and go from there. This new zone we're looking at that's mineralized on surface and has also the downhole analytics that are very helpful to us. That area, that's how we found the North Boundary zone. Sampling on top, on surface, and outcrop as well, and then drilled underneath it, and 3 holes were really quite spectacular. The third hole was 38 grams over 10 meters in one section. There was, altogether, there was 4 zones in that one hole that were all very high grade, up to 22 grams, up to 38.7 grams. I mean, it was really quite an impressive hole. So, I think we could be looking at something similar. This is an area where it's just downhill from a major scree covered outcrop that is a big geophysical anomaly we didn't test last year because it is covered in scree. But it could be what's providing a certain alteration that makes the north boundary high grade and the south boundary lower grade. The potassic alteration diminishes as you head south. So we are suitably impressed and very hopeful.
Jim, for people new to Aben Resources, who's behind the company? What's it all about?
Well, there's myself, Tim Tremundi, Ron Nedlitsky, Cornell McDowell. There's, we're the team that really runs it. As far as shares outstanding, there's 117.5 million shares outstanding. Fully diluted is 168. So there's lots of warrants. If we're fortunate enough, we can get the stock reacts in a good gold market. We could get a lot of the warrants taken down this season. Market capitalization is 8 to 9 million. I've got almost 2 million in the treasury right now. When it comes time to drill, the latter part of August, I'll probably do another raise there for drilling. But I can start drilling first without doing it. If we have really good success, I will raise some money right away and we'll increase the amount we're going to drill. That's what we did 2 years ago. Exactly this. As far as where are we listed, the TSX Venture Exchange in Canada, the bourse in Frankfurt is ABN.V, and down in the United States, it's on the OTCQB, it's E2L2.
Where can people get more information about Aben?
Great new website, ABenResources.com. It's totally new. It's totally up and running. It's got some, it's got some really good graphics on it so you can follow what we're going to do for drilling.
Has the virus crisis caused any problems in BC's Golden Triangle for your explorers?
No, not problems. It's just, like the way I set up this season, I'm sending a geologic team up top. They're all geologists, and they're doing the surface sampling, mapping, and prospecting and all that to fine-tune targets. And, when we do get the drill going, we're going to move, we've got the camp up on top. So those guys are not interacting with the community in any way, shape, or form. And we'll eventually, when we get the drill going, we're only permitted for, I think, 8 people up top. And with the cook and whatnot, that we've got what we need up there. The camp will grow, and so we're going to move it down to the Bob Quinn airstrip where the trailer park is. And I've got a couple of trailers rented. That's what I've had the last 3 years. It's a perfect place. We'll need a helicopter every day to get the crews up and down, but it's a very efficient way to operate. And I think most companies are taking into consideration where they're staying, the shift changes. You got to be careful, make sure the guys are shift changing and they're leaving the community and going home for a week and then coming back, and then they're going straight up the mountain.
Jim, thank you so much for the update.
My pleasure. Good talking to you.
My guest has been Jim Pettit, CEO and President of Aben Resources. I'm Jim Goddard. Our conversation took place on July 28th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.